Welcome to Banking 101, a first principle jargon-free course on banking. In Lesson 1 we developed an understanding of the financial services industry. But increasingly, financial products are provided by businesses outside the industry. In this lesson, we will explore the role of non-financial businesses in delivering financial services. We will also learn the drivers behind the phenomenon. Finally, since this course is called Banking 101, we will learn about models of banking that have evolved for the digital area. We will begin with a recap from Lesson 1 of the 4 terms in our framework that describe the financial services industry. First, Type 1 activity is the act of providing a financial product, for example, issuing a credit card to a consumer. Second, Type 1 entities are entities in the financial services industry who earn majority of their revenues from performing Type 1 activities. Third, Type 2 activity is the act of creating technology, data processing and information services products that are tailored to the provision of financial products. Fourth, Type 2 entities are entities who earn majority of their operating revenues from performing Type 2 activities. But, as we shall soon see, the above definitions of Type 1 and Type 2 entities do not incorporate non-financial businesses. Let us compare two companies who offer digital wallets. In the first scenario, Alice shops using her digital wallet account with a Type 1 entity like a PayPal. Alice funds her digital wallet with her credit card once every 6 months and shops with the balance stored in her wallet. In the second scenario, Alice uses a wallet within her favorite coffee shop's app. Alice can pre-fund this wallet, and every time she buys at the coffee shop, she pays from this wallet. In both cases, the funds are lying in an omnibus bank account that is held by the wallet provider with a third-party bank. The omnibus account commingles the funds of all wallet users. Both entities are engaging in Type 1 activity, in that, they are providing a financial product called the digital wallet. But our definition of a Type 1 entity is somebody who earns majority of its revenues from selling financial products. A coffee shop chain does not fit this definition. Let us now compare another two companies who calculate credit scores on the basis of which lenders make loans to small businesses. The first is a credit bureau whose main business is credit scoring. An example of this would be the Fair Isaac Corporation, that publishes the FICO credit score in North America. The second company is an e-commerce platform where third parties can sell their goods. Since the marketplace platform has visibility to sellers' revenues on its platform, it starts issuing a credit score, on the basis of which, sellers can get business loans from third-party lenders. Both entities are producing a business credit score, which is a Type 2 activity in our framework. However, the e-commerce platform is not a Type 2 entity within the financial services industry. It does not earn majority of its revenue from credit scores. The common theme that emerges from these examples is that entities whom we don't consider to be part of the financial services industry are playing a role in financial services by engaging in Type 1 or Type 2 activity. However, it is possible that a financial services company is born from a non-financial business. At this point, we will use a term for these non-financial technology businesses that earn at least some part of their revenues from selling financial products. We will call them techfins. This was a term coined by Jack Ma, the founder of Alibaba. In Lesson 1, we defined fintech as a Type 1 or Type 2 entity within the financial services industry that heavily relies on the differentiated quality of its technology to deliver its services to customers. Techfins are technology companies that provide financial products to customers. We can now revisit the concentric circles that we reviewed in the previous lesson. At the outer edge is what we will call the financial services ecosystem that consists of businesses that engage in Type 1 or Type 2 activity. This outermost circle consists of both non-financial businesses and financial businesses. The next circle is what we will call the financial services industry. It is this circle which was our focus of study in Lesson 1. This consists of businesses who earn majority of their revenues from engaging in Type 1 or Type 2 activity. A company like Google is part of the financial services ecosystem by virtue of products like Google Pay. But in our framework, Google is not part of the financial services industry. Finally, the inner circle is a subset of the financial services industry that consists of entities with a banking license. Fintechs can sit within the inner or the middle circle. Techfins sit in the outermost circle. At this point, we will step back a little bit from financial services and talk about products in general. A product is a physical object or service that fulfills a customer need. A product has a set of features. The features of a product can be features that are core or add-on features that promote usability. Take a smartphone. Core features include the type of chip, the pixel resolution of its camera, the size of memory, etc. An example of a usability feature is whether the orientation of the screen changes between landscape and portrait modes automatically when we physically rotate the phone. The distinction between core and usability features may not always be clear-cut, but this is a useful framework for the forthcoming discussion. We can think of a product as a summation of two sub-products, a core product that incorporates core features and an extended product that promotes the usability of the core. In our smartphone example, the two are so tightly integrated that the consumer does not think of them as separate. Next, we will apply this framework to a rideshare service like Uber. A rideshare service is a product that fulfills the need of transportation. Just like the smartphone example we just covered, we can break the rideshare service into a core product and an extended product. The core product is the car, and the features associated with it include the standard features by which we typically describe a car. The extended product is the rideshare app. The product features associated with it include many usability features. An example is the ability to get a pre-estimate of the fare and journey time. Another feature is the ability to view the geolocation of the driver on a visual interface. The rideshare company, usually, does not own the core product but owns the extended product. It also owns the customer relationship. Now we will get back to financial services. Consider a digital wallet provider that allows you to store money. Underneath the digital wallet app is an omnibus bank account that contains the funds of all digital wallet users. The wallet provider maintains this omnibus account with a third-party bank. Your balance displayed on the wallet app is simply your share of the funds in this omnibus bank account. The bank account is the core product, one feature of which is the interest rate that the wallet provider may or may not share with you. The app is the extended product. Features could include the authentication mechanism by which you approve payments or the point rewards you earn from the wallet provider. We can now conceive of financial products in the digital age consisting of a core product and an extended product. The core product is often highly regulated. The extended product, on the other hand, is unregulated or lightly regulated. The extended product is often delivered by a techfin or fintech, who relies on a bank-licensed entity to deliver the core product. This architecture enables the techfin or fintech to deliver financial products to their customers without being subject to cumbersome regulations. We had defined Type 1 activity as act of providing a financial product to a customer. This could include the core product, the extended product, or both. Hence, techfins do engage in Type 1 activity. But are they Type 1 entities? Our definition of Type 1 entities are that they derive a majority of their revenues from provision of financial products. That is not the case for techfins. To conclude, a technology company, which is primarily engaged in a non-financial business, but also provides financial products or enables the provision of financial products. Let us now create a flowchart for the financial services ecosystem. The financial services industry, we have learnt, consists of Type 1 entities and Type 2 entities. Type 1 entities earn majority of their revenues by providing financial products. Type 2 entities, in contrast, earn majority of their revenues by selling technology, data processing and information services to Type 1 entities. Some of these entities have a banking license and some do not. The reason a Type 2 entity may get a banking license is that they may also be engaging in Type 1 activities, some of which require a banking license. Now we can add to the flowchart an additional branch consisting of non-financial businesses. They can engage in Type 1 activity by providing a financial product, often in collaboration with a participant from the financial services industry. They could even engage in Type 2 activity. However, we would not designate these entities as Type 1 or Type 2 entities because they do not make majority of their revenues from these activities. What caused the entry of technology-driven non-financial businesses into the financial services space? We will hone in on two important reasons. 1. On the demand side, embedded finance creates greater demand for these services. Embedded finance represents the idea that we like to consume financial services in the context of what we are organically doing. 2. On the supply side, an open ecosystem makes this possible. Next, we will look at each of these drivers individually. Consider a highly advanced car that produces a driver safety report based on your driving behavior. Do you brake too hard? Do you tailgate others? Do you consistently exceed speed limit? In this scenario, the car manufacturer sells you a car insurance policy that you can purchase from the App Store on the car's dashboard. It gets real-time information on your driving behavior and adjusts your premiums on a monthly basis. What are the benefits to you as a consumer? You can buy and renew your insurance from the dashboard of your car. The dashboard of the car gives you the ability to view your real-time driver safety score. By adopting safer driving practices, you can reduce your premium. Perhaps you are going away for a month and not driving at all. You notify the car's app, so that your premium can be lowered for the coming month. The dashboard is the automobile equivalent of the App Store on your smartphone. The purchase and consumption of the financial product, In this case, insurance is deeply embedded into your consumption of the non-financial product, which in this case, is mobility. This integrated experience is difficult to replicate with a standalone third-party seller of car insurance. At this point, you may be wondering why a car manufacturer should bother with intricacies of insurance regulation and risk management. The answer is that the car manufacturer does not need to. It can partner with an insurance company which actually holds the insurance policy behind the scenes and bears the financial risk. The car manufacturer simply takes a fees, similar to an app store taking a slice of sales channeling through it. The embedded finance example that we just reviewed can be understood in 4 dimensions. The first dimension is the primary activity the user is engaged in, which is driving in our example. The second dimension is the primary app of engagement, in this case, App Store on the dashboard. The third dimension is financial product, which is embedded in the app of engagement. In this case, it is the car insurance policy. The fourth dimension is the creator of the financial product, which in this case is the insurance company that is issuing the policy behind the scenes. We can define embedded finance as the seamless provision of a financial service within the primary app with which the user is engaging. The idea of a financial transaction within the context of a non-financial transaction is not new. For example, many people get their car loans at the dealer's showroom. But that is not embedded finance because the experience of buying the financial product, in this case, the car loan, is neither seamless nor digital. The demand for embedded finance is obvious. But just because people want something does not mean it can happen. The embedment of car insurance was possible because the systems of the car manufacturer and the insurance company could connect to each other and exchange information. Embedded finance is made possible by technologies that allow real-time and secure data connectivity between the systems of the product owner and the owner of the customer relationship. Open ecosystems refers to a set of businesses that can interact with each other digitally in real time to fulfill a customer need. A common example of an open ecosystem that we encounter in our daily lives is when we order from an e-commerce marketplace and the goods are delivered to us by a third-party shipping company, like the Postal Service. The e-commerce company's systems and the shipping company's systems can communicate with each other to deliver us a seamless experience. The open ecosystem is enabled by 2 primary technologies, the cloud, and application programming interface or APIs. Let us look at how each of these 2 technologies enable embedded finance. To understand the impact of the cloud on embedded finance, let us take an example from our personal lives. Imagine 2 scenarios. In scenario 1, we have documents stored on our computer. In order to share these files with our teammates, we have to transfer them to a thumb drive or perhaps email them. In the second scenario, we are saving all our files on a real-time basis to a file folder on the cloud. We could simply give access to the right folder to our teammates instead of using thumb drives and emails. Next, we will see why the ability to exchange information easily is important within the context of embedded finance. Let us go back to the embedded car insurance example. The use of the cloud enables data from the car to be continuously shared with the insurance company. Real-time data sharing could automatically notify the insurance company of a collision or theft. The insurance company in turn can transmit data on premiums and bills directly to an app on the car's dashboard. The second technology of interest is application programming interface or APIs. We will again use an example from our daily lives. Alice and Sam are filing their personal income taxes. Alice uses a software called Tax Pro. Sam uses software called TaxCon. Different people could be using different tax preparation software. But as long as the output of the tax prep software is in the standard government-mandated format of a tax return, the tax returns can be electronically consumed by the government systems. APIs can be thought of as data pipes that are consuming or outputting data in a predefined format. This permits systems of different businesses to consume data from each other easily. In this example, the tax department is providing an API to which different tax prep software companies are connecting to. In our car insurance example, if the car manufacturer produced driver safety data in a standard way, any number of insurance companies could consume that data and use that to underwrite insurance policies. The car maker can just build an API. Insurance companies can access data via the API subject to authorization by the car manufacturer. Imagine the alternative, where the car maker is developing custom data feeds for every individual insurance company. This will limit the ability of the car company to offer insurance to its drivers globally. The technologies underlying the open ecosystem permits the decoupling of financial product ownership from customer ownership. This allows entry of non-financial businesses into financial services, without being regulated. To recap, non-financial technology businesses increasingly participate in financial services because embedded finance delivers a superior customer experience. Additionally, open ecosystem technologies makes embedded finance feasible. But since this course is Banking 101, next, we will learn the impact of this on the banking industry. The open ecosystem, facilitated by cloud and API technologies, enables new models of banking. To understand what these models are, we would consider two fictional entities. The first entity is a fictional bank called Gotham National. The second entity is a fictional fintech called Hooli. From Gotham National's perspective, there are four possibilities. Quadrant 1 and Quadrant 4 are the extremes. Quadrant 1 is traditional banking where the bank owns the distribution channel as well as the product. In Quadrant 4, the fintech owns both and the bank has no role to play. It is in Quadrant 2 and Quadrant 3, we have alternative models. In Quadrant 2, the bank becomes the channel for Hooli's financial products. Quadrant 3 is the inverse, where Hooli becomes the channel for Gotham Bank's products. Let us explore these two concepts of marketplace banking and banking as a service further. We will begin with marketplace banking. Imagine a financial marketplace that is your gateway to all financial services. You open a digital wallet within this marketplace. The funds in the wallet are held in an underlying insured bank account with a third-party bank. Once you transfer funds into the wallet, the marketplace connects you to a brokerage firm and you can use the funds in your wallet to buy stocks. The marketplace also allows you to buy and sell cryptocurrency. You also are in the process of buying a home. So, you take a mortgage loan from a lender on the marketplace. You also need insurance for the new home. You connect with a home insurance provider on the marketplace, who gives you a better deal, if you also switched your car insurance to them. You get the idea. This is the concept of marketplace banking where the bank is trusted gateway to a host of financial products. It is instructive to see the difference between embedded finance and marketplace finance. In embedded finance, the customer engages with multiple apps depending on the context of the activity. In marketplace finance, on the other hand, the customer engages with the marketplace app, which then acts a gateway to multiple product sellers. Let us now move on to banking as a service. To understand banking as a service, let us review an example, which is identical to the earlier car insurance example, but the product now is a bank account, instead of insurance. Alice owns a small business which designs and sells jewelry on an e-commerce marketplace. Alice also banks with Gotham National Bank. When people buy on the e-commerce marketplace using their credit cards, Alice ultimately receives cash in the bank account she holds with Gotham National. Alice needs to log into the e-commerce platform to view how much sales have occurred. She then needs to switch to her bank's online banking portal to determine whether the associated cash has come in. But since the systems of the bank and the e-commerce system are not connected, Alice is constantly toggling between the two. Now the e-commerce platform company on which Alice runs her store starts offering a bank account through its own app. The bank account is owned by Gotham National Bank behind the scenes, with data being exchanged between the two companies seamlessly. Now Alice can see both her bank activity and her sales activity at the same place. The e-commerce platform company observes that when Alice's customers pay by credit card on the site, it takes 3 days for the cash to get into her bank account. Hence, it connects the platform with a third-party lender who funds Alice's bank account on a real-time basis every time she makes an online sale. The lender gets automatically repaid when the cash flows in on the third day, earning small amounts of interest on these short-term loans. In the example we just reviewed, the bank that owned the underlying bank account was providing its services through the app of a third party. This model is called banking as a service. Banking as a service refers to the provision of financial products through third-party apps. As we learnt earlier, this is made possible by cloud and API technologies. At this point you may be thinking whether embedded finance and banking as a service are the same. Embedded finance is simply a subset of banking as a service. We use the term banking as a service whenever a financial product is delivered digitally to a customer via a third party. If the third party is a non-financial business, as in our previous examples of a car manufacturer and e-commerce platform, we use the term embedded finance. Next, we will review an example of banking as a service, which is not embedded finance. Consider Susan, who is a customer of the fintech Hooli. Susan conducts most of her interactions with Hooli's app. Susan has a business loan from Hooli, but she also wants to move her checking account to there. Hooli does not want the regulation that comes with offering checking accounts. So Hooli sticks to its core business of lending but connects Susan via APIs to Gotham Bank. Susan does not care that Gotham Bank is behind the scenes. For her, this is just an additional screen on her Hooli app. We are not using the word embedded finance here because the third party, Hooli, is a financial business. But we can still use the term banking as a service. This would be a good time to get familiar with a very specific term used within the context of financial services. The term is open banking. Open banking refers to the ability of third parties to connect to the bank account of a customer via APIs, with the express consent of the customer. The connection could be established for extracting information only. For example, a consumer may allow a lender to access her bank account data digitally as part of a loan application instead of emailing her bank statements to the lender. The connection could also be established for the purpose of transacting. For instance, a consumer could authorize a payment from a bank account at the checkout counter of an e-commerce site without using a debit card. The request to authorize the payment is transmitted to the bank via an API. Open banking and banking as a service can be seen as antipodal descriptions of the same idea. The term open banking is used in the context of describing the ability of third parties to access bank data and services. It is a pull perspective. The term banking as a service is used in the context of describing a push from the bank to third parties. In certain jurisdictions, like the UK and the EU, open banking was driven by regulators who mandated large banks to provide APIs. In other countries, like the United States, open banking has evolved from customer expectations. Both business and retail customers of banks use third-party apps for financial transactions. Hence, they benefit from seamless connectivity between their bank account data and third-party apps. Historically, there has been tension between banks and fintechs with regard to open banking. Banks cited the need to be restrictive for reasons of data security, while fintechs claimed that banks were deliberately stalling competition. However, regulation or not, the world is moving towards an open ecosystem, of which open banking is a specific expression. This is a good time to recap the takeaways from this lesson. Non-financial businesses, especially technology companies, increasingly play a bigger role in delivering financial products to their customers. They are enabled by the demand-side vector of embedded finance and supply-side vectors of cloud and API technologies. New models of banking like marketplace banking and banking as a service have evolved in response to broadening competitive landscape. This brings us to the end of this lesson. Next, review the summing up section of this lesson and then move on to the next lesson on capital markets.